Hey you guys, so in this video we will be discussing the accounting cycle. The accounting cycle is the process by which companies produce their financial statements for a specific time period. In this there's going to be a total of 8 steps to finish out this process. The first step is to identify all the transactions that have been made within the time period. All of these will need to be properly recorded in the company system. If not, this could lead to inaccurate amounts in each of the accounts. For example, if I misread flour and used powdered sugar instead, then the end result of the muffins would not be the same. The second step is making journal entries for these set transactions. With accrual accounting, these transactions are booked at the time of sale, since revenues need to match the expenses. Cash accounting is slightly different since transactions are posted when cash is either received or paid. Third, we are going to post these journal entries to the general ledger. This ledger provides a breakdown of all the accounting activities by their account. Using this ledger makes it easy to maintain and be aware of the account status and financial position it is currently in. For example, one account is the cash account that shows how much of the company's cash is readily available to them. Step 4, we get into the unadjusted trial balance. At the end of an accounting period, this will show a list of all the general ledger account balances before any adjusting entries are made to it. This gives a good basis for analyzing the end balances and figuring out what adjustments need to be made. These only need to be done if financial statements are needed to end a period. Another key fact is that unadjusted trial balances are only used in double entry bookkeeping, where all the entries need to be balanced with a credit and a debit. If a company were to use a single entry system, then a trial balance would not be possible since there's no secondary entry to compare it to. Fifth is the analysis of the actual worksheet. When looking to make adjustments, you need to make sure that all the debits and credits are of equal value. If there's a discrepancy with any of the accounts, then an adjustment is needed. After everything is analyzed, this is when adjusting the journal entries would occur. The purpose of adjusting entries is to convert cash transactions into the accrual accounting method. These entries involve an income statement account, which is revenue or expense, along with a balance sheet account, which is an asset or a liability. Adjustments that may need to be made on a balance sheet are accumulated depreciation, accrued expenses, accrued income, prepaid expenses, deferred revenue, and unearned revenue. Income statement accounts that may need to be adjusted include interest expense, insurance expense, depreciation expense, and revenue. The reason these adjustments are so important is because they reconcile differences in the timing of payments as well as expenses. Without these adjustments to the accrual or to the journal, there would be many unresolved transactions that are not yet closed. The seventh step is to prepare all the financial statements. To do this, you need to reference the adjusted trial balance to see how each account is distributed. These financial statements need to be done in order to get the final product, just like the ingredients when baking muffins. If these steps are not followed, you may be unhappy with the results. The income statement, which shows revenue, expenses, net income, or net loss, is the first order to be complete. Next is the statement of owner's equity, which displays the change in capital as a result of owner's contributions, owner withdrawals, and net income or net loss. The last statement would be the balance sheet where assets, liability, and owner's equity are reported. Companies typically only use a classified balance sheet where every asset or liability is placed into a category. The assets will be in only 2 categories. One is current assets that are used within a year or converted to cash, and long-term assets that are not converted to cash or used up within the year. Liabilities also just have 2 categories. One is current liabilities that must be paid either with cash or services within the year, and long-term liabilities that do not need to be paid within the year. Lastly, in the accounting cycle is closing the books. The closing process zeroes out all revenue accounts and all expense accounts in order to measure each period's net income separately from all other periods. This will also update the owner's capital account balance for net income or loss during the period and any withdrawals made by the owner. Doing this prepares the accounts for the next accounting period. Revenues and expenses are called temporary accounts or nominal accounts. The owner withdrawals account is also temporary and must be closed because it measures the payments to the owner for that specific period alone. Assets, liabilities, and owner capital are called permanent or real accounts. These are not closed at the end of a period. Closing entries transfer revenues, expenses, and owner withdrawal balances to the owner capital account for the next period. There are 4 steps to closing the books. The first is to make the revenue accounts equal 0. This closing entry transfers total revenues to the credit side of the income summary account. Step 2 is to make expense accounts equal 0. This entry transfers total expenses to the debit side of the income summary account. The third step is to make the income summary account equal to 0. This closing entry transfers net income or net loss to the owner capital account. The last step is to make the owner withdrawals account equal 0. This entry transfers the withdrawals to the debit side of the owner capital account. After these entries are all closed, a post-trial closing balance needs to be done. This will list all the accounts with their balances after the closing process. Only assets, liabilities, and owner capital, which are the permanent accounts, will appear on this trial balance. No temporary accounts will be included. Everything in the ledger is now up to date, and the accounting cycle has been complete. We now have a finished result and are ready for the next counting period.